One of the very important investment questions today, particularly with the growth of alternative investments in diversified portfolios, is the performance of private assets vis-a-vis public assets. We've said for many decades now that our expectation is that privates, because of their lack of liquidity, should do about 3% better than their public equivalents over a long period of time. And we've demonstrated that recently in terms of private debt versus public debt. Our expectation of a 3% delta has actually turned into a 5% delta. I want to talk briefly today about our research in private equity versus public equity. And consistent with that comparison to debt, we actually find closer to a 5% delta between private equity and public equity. That 5% delta is basically meant over a long period of time, over a 10-year period, that you earn twice as much in private equity as you do in public equity. So as a proof statement, if you look at this slide, we track the performance of private equity as an asset class versus public equity or public stocks as an asset class. And this database, which I'll describe, goes back over 20 years, 22 to be exact. There's a lot of universe data out there on individual GP performance by vintage year, by subsector. But we like this database because it shows what a broad collection of private equity funds across many sectors and vintages, how that has performed over a long period of time. And this database comes from audited financials of state pension plans, their private equity performance. And this is collected annually on their fiscal year, which is generally June 30. At the end of 2022, that private equity database totaled about $500 billion and represented approximately 15% of total state pension assets. So a very broad, diversified sample set over many, many years. So if you look at this line, the axis, the left-hand axis, y-axis, we show this in log scale. So this is cumulative return on a log scale, which basically means a straight line is a constant rate of growth. So the cumulative rate of return on private equity, the heavy blue line, is shown in the at the top there, with a cumulative return of 11.4% per annum. So that's the performance of state pension plan, their private equity asset allocations over a 22-year period. We compare that with publicly traded stocks. And our benchmark here is a combination of US stocks measured by the Russell 3000 Index and non-US stocks measured by the Morgan Stanley ACRI ex-US Index. We weight those two indices 70-30 because that is both statistically and fundamentally what the weight of private equity is within the US borders and the non-US borders. So the performance of publicly traded stocks over the same time period has been 5.8% per annum, about half of what private equity has performed. We also show the difference between the public and private on a year-by-year basis. Those are the bars, and you can reference the right-hand axis as a measure of the difference on a year-to-year basis. Notice that most of those bars are blue, indicating they are positive, twice as many years being positive. Again, private equity doing better than public equity, than negative, which are shown in red. We also show in the dashed line the cumulative excess return for private equity. So this is a plot over time of the cumulative excess return, and you'll notice that there are some ups and a few downs. So for the first half of this time period, it was generally a positive through 2010, where private equity did much better than public equity. During the approximately 7 or 8 years post 2008, and this was a period where public stocks did very well. Remember, this was the tech boom years. Private equity basically, on the average, kept pace with public equity. You notice that dashed line over that time period through about 2017, it was pretty level. So basically, public stocks and private equity did about the same. I will also mention 2007, there were a lot of academic articles and other so-called experts that said private equity was dead, that it had lost its mojo. And it's typical fashion in the investment business, as soon as you declare something dead, it comes alive again. And so it did. So beginning in 2018 through 2022, private equity took off, and relative to public equity, and that spread is now widened significantly. So in summary, again, for those who want to invest in private assets, I think a conservative assumption is 3% higher return, even though we're measuring both on private debt and private equity a 5% delta. It doesn't, particularly in the case of private equity, it's not as consistent as it is in private debt, but it is meaningful and significant, really over time periods stretching between 5 years and 10 years. Hence silencing a lot of the critics that had spoken up approximately 5 years ago. Thanks for your attention.